Welcome back to the Business Forum Show. I'm Kevin Hunter. My guests are Dia Johnson and Mike Niznik from Carlson Advisors. And I wanted to have a little conversation about entity structuring. What's appropriate for a given type of business? There are many different entities you possibly could have. So I was wondering if you wouldn't mind sharing some stories of some organizations that have a specific entity type, why that was appropriate for them, and maybe what some of their products and services are, just for some examples.
I'd say a lot of it depends on what the client or the taxpayer wants. I mean, probably one of the most popular entity structures right now is called the LLC, or a limited liability company. And I think a lot of people, when they hear that, you can ask them and say, what does LLC mean? And they'll say limited liability corporation, and it's not a corporation. You can elect to become a corporation, but most of the time I like to at least start people out as an LLC, because I think there's a lot more flexibility. Assuming a business in its first couple of years is probably not going to be profitable. They're going to struggle to make money, so on and so forth. If it's a single owner, the owner may not have to file a separate tax return. There's a concept called the disregarded entity. And so if, let's say, it's a service provided organization, and it's just one owner, he would just file that as if he's a sole proprietor and include that on his personal return. There's advantages and disadvantages. The disadvantages, all of that is subject to his income tax, also what's known as self-employment tax. Most business owners probably know what that is. But the ease of it is he doesn't have to do a separate tax return for the entity. He can take money out, draws. All of his money that's available to him is already been taxed. Now, once you get beyond those kind of loser years, for lack of a better way you become profitable, it might make more sense then to elect CCorp, which is a corporation, and you can actually do that without actually incorporating. There's what they call the check the box regulations, and you just make that change. So legally you're still an LLC, but you elect to be taxed as an S corporation. And a lot of that's the same operation, but now you've created a couple of things. You now have to do a separate tax return for your corporation. So you've got some administrative costs there. And it's a little tougher to get money out. Now you become an employer of your corporation, so you're going to have to take a paycheck. IRS actually watches that, because there's been games played historically, and that S corporations just take distributions out similar to what they did as an LLC. But now there's payroll taxes, and the IRS want those payroll taxes.
Sure.
So they're going to look for some sort of minimum salary to come out. Well, then you got payroll taxes, you got W-2s, you got quarterly payroll tax returns. So there's advantages, but there's also some other things you have to weigh, some additional costs that you have to weigh. So,
what about some other entity types, Dia?
Well, there's also the C corporation. We don't have too many of those, but what that is, it stands by itself. It's its own tax entity, so it pays its own tax on its income, versus an S corp where the income flows through and is picked up on the individual return. The one benefit to a C corp is similar to the sole proprietor, is that in the beginning years, when you don't have a lot of profit, and what profit you do have is probably paying off debt, a C corp, the first $50,000 is only taxed at 15% federal, and so you're paying a pretty low tax to get started. And what we'll do with a lot of those C corps is we'll watch how that works and where the tax rates are, and at some point we'll flip that also to an S corp, so they can start taking the distributions out along with their wages.
I have a little scenario that I wanted to run by you guys, and you can comment on this. I became aware of an organization, and when we're talking about, the tax benefits of certain company types and entity structuring, there was an organization that was an American based firm. They opened up a Canadian subsidiary, and they put in a obviously completely separate management team and everything else to run the Canadian subsidiary. Well, these two organizations weren't communicating that well to each other, because the Canadian subsidiary developed also American clients, and they opened up an American subsidiary of that organization. So, long story short, without realizing it, there were cases where the parent company in the U.S. was shipping stuff to the Canadian entity, who then was shipping stuff to their. And by the time this all got done, that seems like a lot of nonsense and a lot of wasted time and everything else. But the other bigger issue here was that by the time goods traveled from U.S. to Canada, from Canada back to U.S. and to their client, and all the appropriate taxes were applied to all these transactions that took place, they were at about 70% of gross sales was what they were being taxed on. Have you ever seen such a situation or heard of such a situation happening?
I haven't heard of that. I'm a little familiar with the Canadian law. So I mean, basically, a company pays tax on their worldwide income. So
Sure.
So they're going to pay U.S. tax. They're going to probably pay Canadian tax, and then the provincial taxes up in Canada are high as well.
Mm-hmm.
And then they're probably paying a state tax back here, depending on what state they're based in. So there should be some. Well, if you're just talking income tax, but there might be value-added tax and things also that get exchanged in Canada that we don't have here, and then there should be some kind of credits, at least if it's a domestic U.S. corporation. But again, if kind of the way you described it, it sounds like they started a Canadian corporation as well. So I'm not sure where the domicile was there. Maybe they never defined that.
My chief question in all of this, as I was hearing this story unfold, was who are you talking to for advice? And obviously maybe nobody, but who was the organization talking to advice in this whole process? Because obviously that's a heck of a big mess to get into. And you know, having a pretty good size operation to do that. Are there any situations where you've seen companies, you know, create a entity structure that was inappropriate for them and put them into a tax base that was much higher than what they expected?
I have seen that. One of the other entity choices are if you have real estate,
Mm-hmm.
it should be in an LLC. And again, if you're the only owner, you can keep it within your individual tax return. But if you're in there with multiple partners, there's a partnership return filed. Well, a lot of times people will put real estate inside of their corporation.
Mm-hmm.
And so what that does is, historically anyway, real estate has gone up in value. So you have an appreciated asset inside of a corporation. So you end up with an extra tax when you either distribute that out at fair market value or in a C-Corp, you'd have the double tax on the appreciation.
Ah, very cool. And Mike, how about you?
Yeah, Dia kind of mentioned earlier that a lot of our clients are S corporations or flow through type. We don't do that many C corps. Lots of times we'll get clients, and the first thing we'll do, a new client, is analyze: are you the appropriate entity structure?
Mm-hmm.
And by doing an analysis, okay, you're a C corp right now. And one of the biggest things we look at is the end game.
Mm-hmm.
You know, there's a double tax when you decide to get out. And if you do an analysis with an S corp, it's a much better answer. So lots of times we'll convert, and there is some effort that needs to be done there. But that's why a lot of our clients, we just don't leave them as a C corp because there's many disadvantages.
Mm-hmm. For the people that are unfamiliar, Mike, you mentioned this, that a LLC is a limited liability company. For people that aren't familiar with the difference between just a company structure is versus a corporation, elaborate on that.
Well, one of the things that it seems to come up a lot is at your end with 1099 issuing. I think most business owners know you don't need to issue a 1099 to a corporation. Where an LLC, there's a lot of confusion there.
Mm-hmm.
Let's take Carlson Advisors for an example. We're an LLC, and you should issue a 1099 to an LLC.
Mm-hmm.
And so we should get a 1099 from all of our clients. You know, we don't because they think we're a corporation. So that's one of the areas. And a lot of it comes down to what I described before. How are you getting paid? There's benefits. Well, it's probably similar between LLC and corporation, but what kind of tax return should you be filing? A lot of things like that.
Mm-hmm. Dia, you have any thoughts you want to add to that?
Well, an LLC or a limited liability company is basically set up. It looks more like a partnership when you do the documentation, whereas a corporation actually has stock certificates. So
Mm-hmm.
The base that starts out looks more like a corporation.
Well, we're just about out of time. In fact, the last minute or so here. But any parting shots as far as advice that you'd give to the many small business people that are opening up an organization today, in today's market?
You know, one thing we talked about a little earlier is about bookkeeping. I think a lot of business owners just, especially with software right now availability, I don't think they need help with that.
Mm-hmm.
I would say you probably do, and you might save money
Mm-hmm.
by getting some help with that initially and getting set up and off to the right foot.
Well, 96% of the million-plus people that start a business every year do not see a 10-year anniversary, and one of the big mistakes they make is not getting good advice when it comes to their accounting and bookkeeping. Kevin Hunter on the Business Forum Show. My guests are Dia Johnson and Mike Niznik from Carlson Advisors. You can find them on the web, carlson-advisors.com. You can also call them at 763-535-8150. Again, 763-535-8150. Kevin Hunter on the Business Forum Show. Thanks for listening.